Hi everybody, welcome to Portfolio Watch, your stock market guide on what is hot and not. I am Fifi Peters. On today's show, we examine the impacts of the global trade war, tech war, following US President Donald Trump's decision to ban Huawei from operating in America. In the second half of the show, we take a look at how many of the heavyweights on the JSE have invited black investors to participate in its BBBEE schemes and how you can create profits for your portfolio. Do get in touch with us throughout the show. You can tweet us your thoughts using the hashtag PortfolioWatch, tag CNBC Africa, and of course you can tweet me at Fifi Peters. Let's get straight to it now. The US-China trade tensions have manifested into a tech war with Huawei on the front line. Trading prohibitions could mean a slowdown for economic growth and not just in the tech sector. Many countries have been pressured to take sides, which will lead to inefficient prices. And joining us to discuss how to navigate your investments during this trade war is Andre Cilliers, Director at TreasuryONE, and Leigh Riley, Wealth Manager at AlphaWealth. Gentlemen, thanks so much for your time. Now, I suppose in the month of May, the old adage that sell in May, go away has played out. We've seen it play out. I'm wondering if the extent to which share prices have been bruised has been exasperated by the fact that the US and China are still not at peace with each other in terms of trade. Andre?
I would think that the impact on markets at this point is very much determined by what happens between Donald Trump and the Chinese and the impact of that on world growth. I would caution to just look at certain tech stocks because of the banning of Huawei and so forth, but because on the other hand, Samsung's doing well, and you know, people get onto this boat because they've got one of their phones in their pocket and they took it out last week signing a contract. So it's very much to the forefront. Now, I don't think those decisions should drive investment.
Yeah.
But the trade war, definitely one of the forefront things in the market that will impact on world growth and on company profitability, obviously then how well they will be doing on stock exchanges and so forth, and how well your equity portfolio will perform. So definitely an impact. I think to a lesser extent, this whole sell in May, go away thing is impacting on it. I think the Chinese trade war is... It's
the trade war.
It's the forefront.
And you, Leigh, is it all about the trade war, or did we see, you know, that adage play itself out?
Yeah, it's different. It's difficult to quantify because when you look at what they're even calling the new technology Cold War, and the way that it's been panning out. You know, the trajectory of the way that the market was moving and the way US earnings have beat largely this quarter as well, I think the expectation is that even if we had grounded to a bit of a halt during the US and European summer, things still would have continued to tick up nicely. So I look at this and I look at the knee-jerk reactions. I think the context is more about the longer term negative perception of what it means between China and the US. You know, 6% of, if we look at a company stock like Huawei's, revenue comes from the Americas in total. So that's Central, South, and the United States. But it's the context of what that prepaves for other companies. Huawei's got over 180 different vendor partnerships. One of the reasons they haven't been hugely popular in the United States is because largely the distribution of those phones is controlled by the likes of T-Mobile, so cellular networks like MTN or Vodacom locally.
Yeah.
The context is that it spans across a whole multitude of different companies and different asset classes. It just is a very loose rhetoric that's been rolled out by the United States, where they've said if you have or do contribute to any kind of social or a local social security threat or international security threat to the US, regardless of whether you're a tech company or not, your ties are going to be reviewed. So, you know, looking at all of that, the knee-jerk reactions, you know, every time Trump picks up his cell phone and tweets, we're getting to a scenario where we have a knee-jerk reaction.
Yeah, but knee-jerk reaction is what we're seeing currently play out right now. But then how concerned, Andre, you also raised this in terms of your concerns about global growth, because if this is something that continues, because it does look like it's here to stay for now, what then does that mean for the kind of strategies you're employing to protect your value?
Okay. Now, I think Leigh had mentioned it very briefly. When one looks at investments is not over a 3-month horizon. And over a 5-year and a 10-year horizon, economic fundamentals will always play out to be the sound principle on which you should base your investment decisions, not on social media tweets. And I get the idea lately that social media, we're talking about a trade war, but a trade war is actually, there's discussions about the trade agreement, then it's on, then it's off, but the reaction is followed after tweets by people.
Yeah.
And then the media actually runs away with this. Now, to let that
but
influence
we don't do the
your...
selling.
No. But let if those decisions or those tweets are going to influence your investment decisions, I think you're on very thin ice. I think economic fundamentals, how the economies of different places in the world and geographic areas will perform in the future, that is what should drive your investment.
But the thing is,
and then the asset classes in which you are.
But these tweets are impacting the way that people make decisions. Every time, as Leigh did say, when Donald Trump tweets something that is controversial, that people are worried about, you see it play out in the markets. And for me, Andre, are you saying that with all this noise happening right now, you should sit still on whatever you have based on your fundamentals, obviously, of how you're positioning or how you see the company against the backdrop of the economy and the like? Or should you run away like everyone has been?
If you have a diversified portfolio,
right,
and in your portfolio you have a certain amount of cash, then you would not need to run to the markets and make a hasty decision because of a tweet. You would have the time to actually analyze the impact of that and the way forward, and then make an informed decision as to whether you should adjust your portfolio or not.
So what about some of the, in terms of portfolio adjusting, if you're thinking that, okay, maybe I should take advantage of the fact that some of these companies have been heavily sold off and perhaps now is the time to get in because eventually things will work themselves out in the long term. Is anything or does anything catch your eye on that front, Leigh?
So I agree with Andre in that it's impossible to make a decision on something so binary. If you're going to be swinging your portfolio around based on politics, then I think you drastically need to reconsider how you are investing. Because as we've seen over the last 2 to 3 years, we've had Trump, we've had Brexit, we've had scenarios where despite all the smartest people in the room forecasting that the complete opposite was going to happen, we ended up with Trump leading the most powerful nation in the world and the Brits choosing to exit the EU, all of which everybody thought was never going to happen. I do think that if we take it from a very simple point of view, so if we look at price to earnings valuations, right, and we look at a 17 to 20 year period and we compare the US, Germany, Japan, South Africa, and China from an annualized return point of view in US dollar terms, South Africa, interestingly enough, comes up trumps with around 8.5%. China, not far behind. The key part about that is the volatility that you experience in a long-term portfolio like that, and whether you've actually got the guts to it, and obviously whether your mandate as an investor allows for that. You're also not going to go and throw 50% of your portfolio into the Chinese market if you've got a lack of transparency. It's historically been notoriously challenging to try and invest there. You've got a huge amount of state control. As it stands now, we're talking about a 33% odd discount to historical valuations from a price to earnings point of view in China. The US is around sort of ballpark figure around 4% overvalued at this stage, but company earnings forward company earnings are still make it look fairly attractive. If you look at it from a real growth point of view, which is where we take GDP and we strip out inflation, then the US and China are still clear winners globally. The difference is the policy reform and what takes place. And don't forget that during the course of the year that things like MSCI indices are going to be reweighting China because of the growth of some of these tech stocks. If you hadn't been in the market last year and taken part of some of the tech run up until about August, September, you would have lost out.
All right.
If you'd held those stocks in the US, you then would have had a very, very bad latter third or latter quarter of last year because of how those stocks were sold off.
Yeah.
So time frames have got to give us some kind of context. I think valuations, the economies, the scale and the size of these different areas, I think those are all things that you've got to consider when you look at GDP growth, inflation, the consumer base, who you're selling to.
All right.
Those are all important.
All right. I mean, just as we wrap, if you guys could, I mean, your picks based on these strong fundamentals that you're talking about, when having certain companies or certain asset classes in your portfolio, what would the main ones be that you are currently holding right now, Andre?
Okay. First of all, being a South African, I would, in my portfolio, be in the opinion that you should look less at investing in other emerging markets and more in first world markets, as we said last week, because we are in an emerging market and we will be impacted more as an emerging market with trade wars and these things. My personal feeling would be that I would go into equities that's more driven by consumer demand, less, in other words, people that use the nuts and bolts, what they use every day. Yeah. I tend to look at that more a little bit at this stage. Food and restaurants and pharmaceuticals,
right,
those
shoes.
Things that people really need every day.
All right.
Not the once-off buys or so forth. I would look at
those people don't have a lot of money right now. If you're looking at it from a South African context and the consumer
personally, I would stay a little bit away from tech stocks. I don't think.
Oh man, that's coming from a man with 1 or 2 grey hairs.
Yes, I would stay, but for
like
the moment, longer term, I would go back. But at this point in time, I would most probably stay away from it.
Stay away. Leigh, quick one, you agree? Stay away from tech stocks?
So I like the valuations in some of the tech stocks.
Right.
I have the feeling that as the incumbents, they're going to continue to grow. I think the thing that will probably block that or be a bit of a hindrance is regulation. So I do like the Baidus, the Ping Ans, the Tencents.
Huawei?
Huawei, yes, but I think these tariffs are broad-reaching. Okay. I do think, as you know, behind Samsung, they're the largest producer and seller of handheld devices, ahead of Apple. They've got 500,000 programmers who are writing code. You can't ignore the sheer size of some of these companies and how progressive they are, particularly when you start looking at things like 5G. It's Huawei, Nokia, and Ericsson, and that really is the next frontier.
All right.
So that makes it attractive for me.
Quite a diverse range of ideas and opinions here. Consumer stocks this side, the tech junkie there. But thanks so much for your time and your advice on how to navigate what is becoming a trickier situation, and that being the trade war, or now many calling it a tech war between the US and China. Thanks once again to my guests, Andre Cilliers, Director at TreasuryONE, and also Leigh Riley, Wealth Manager at AlphaWealth. Coming up after the break, we will examine how empowerment schemes can be worth the wait. Do stay with us as we consider what stocks to keep in your portfolio. Welcome back to Portfolio Watch. BEE share schemes have been extensively criticized for their lack of liquidity and extensive empowerment periods, yet the return for some of the schemes have been worth the wait. Joining us to discuss which BEE shares could have high yields for your portfolio is Riaz Gardee, a BEE commentator, and also Craig Gradidge, investment and retirement planning specialist at Gradidge Mahura Investments. Gentlemen, thanks so much for your time. So if you are a qualifying investor, as in, you're black, you're formerly disenfranchised from the formal economy, should you be looking at investing in BEE share schemes as part of a portfolio diversification strategy? Craig?
Yeah, I think you've hit the nail on the head. It's definitely part of a diversified portfolio. These shares, while they have delivered excellent returns over the long term, they do have challenges, and one of those main challenges is the issue of liquidity. So you do not want to put your entire portfolio into an illiquid asset, and these things often trade at discounts. So you want to have a portion of your money there. But it's certainly part of diversification.
So, ordinary talk, if something is trading at a discount, that's a good thing. But except it's not a good thing when it comes to BEE schemes. Explain why.
No, I think it's a good thing if you're buying.
All right.
It's not necessarily a good thing if you're selling, because if this thing is worth 100 and you've got to sell it for 80, So for the seller, it's not a great thing. For the buyer, it's a good thing. But the discount is there all the time,
all right.
Because of the liquidity issues. But what that discount does is that it enhances your yield. So the dividends that you get paid are typically higher because of the fact that you bought it at a discount. So I think the discount, yes, while frustrating, if you know that these are assets which typically are valued at a discount, then you will, as the value increases, your asset will increase in value, but it will remain at a discount to its NAV.
And Riaz, right now the talk of the street is BarloWorld's property BEE scheme. Mixed reviews I've read on that front. Some questioning, why it's not actually linked to BarloWorld's main bread and butter business. Where do you sit on that view regarding BarloWorld's BEE scheme? Should we be getting into this?
Yeah, thank you. So look, I've written extensively on that, and I would say that they have linked it to the property values, which has advantages in the sense that it's not as volatile. If it were linked to the share, it would be more volatile. So there's definitely pros and cons of each option. And therefore, the investor needs to assess how much risk he wants. Coming back to what you said about portfolio diversification. So in diversification, you'd want assets which are not correlated to each other. A simple adage is, don't put all your eggs in one basket.
No, for sure. Craig, your take on BarloWorld's BEE scheme?
Yeah, I think the Cilliers deal looks like an attractive deal. So it's the first property-backed public broad-based BEE share offer. All the others are equity-backed. So there's with property you get rental income, whereas with equities you're relying on dividend income. So there's a lot more certainty around the flow of cash into Cilliers.
Okay.
Also, given the facilitation offered from BarloWorld, where they've signed a 10-year lease with a guaranteed 8% per annum increase in the rental, and it's a triple net lease, it takes a lot of the risk out of that deal. And it makes it a fairly attractive deal for investors. Number one, they get an extra leg of diversification in having a property-backed investment. And I think BarloWorld have been quite clever in terms of how they offer the facilitation.
Sure. All right, so for viewers watching this and having questions around BarloWorld, you guys are saying, don't question. If you've got the money, just get in.
I think if you're comfortable with the lock-in period, so first 5 years you can't trade. It's a 15-year empowerment period. And the value is going to be back-end loaded, in that as the debt is settled, the value will start to emerge in your investment. So the value comes from the debt settling, and then the value of the property is increasing.
All right, Riaz?
So yeah, maybe I can just give an analogy for the viewer. So it's almost like buying a property with credit from the bank. You leverage it up 80%, and you use the income from the tenant to repay the debt. In this case, BarloWorld is your tenant. So you've got a AAA grade tenant who's secured the lease and who's guaranteed the transaction. So it's very favorable terms for someone who would be looking at that.
Okay, and then we are staying with you. Other than BarloWorld right now on the table, what other BEE schemes offer the potential for attractive returns?
So typically, the best time for BEE transactions are when they start or close to the end. As Craig said, that when you come in, there's a discount. So you want to come in when there's the discount up front, and close to the end, the discount unwinds. So the other BEE schemes that are on the go, they're already trading at those discounts. So that's why BarloWorld at this point in time is the hot one to look at.
Right. And for you, Craig, any other ones that catch your eye?
I think it's going to be interesting to see how the Putumanati restructure plays out.
All right.
So investors will be given the opportunity to swap into multi-choice group, and we need to see what the terms of that option will be and when that's going to come through. And then the other one is Vodacom Yebo Yetu, which you can trade on the JSE BEE board. That Vodacom Yebo Yetu is attractive for me as in that I have the risk tolerance for it. It's a fairly volatile scheme at the moment, in that 80 to 90% gearing, and you're referencing to the Vodacom Limited share price. At the moment, we get a fair value of around 23 Rand a share. So that's after discounting the net asset value of just over 30 Rand a share by about 30%. And it's trading at about 17, 18 Rand a share. So we think there's some good upside there. The key catalyst for that is the Vodacom share price.
All right, okay.
And dividends. So they are paying those dividends. The dividends are a lot more stable than the share price, so they'll be servicing that debt. But that one reminds me of Putumanati 10 years ago.
Okay. Okay, in what
which was
sense?
when you wanted to get into Putumanati.
When you wanted to get in, right. What about, I mean, you mentioned Vodacom. I know guys that, benefited quite a bit, made quite a lot of money out of MTN's Zakele's scheme. They've got the Zakele Futhi on. Sasol, I know, has also got something on. And I hear that Discovery Bank is also coming on with something. I mean, what do these stand out for you? Or perhaps just to add to that, I mean, as an ordinary, maybe a startup kind of investor, looking at these schemes, I mean, what should you be looking out for when you've got these big companies announcing their various schemes, Riaz? So
you should look out for the underlying value which you are buying into. So the value will be correlated to the asset that you're getting. If you're happy with Vodacom, the price would react similarly. If you're happy with Putumanati, it will be linked to, the underlying investment. So you should be happy broadly, in principle, with the company that you're investing. In the BarloWorld, you need to be happy with the property portfolio.
What are some of the common mistakes, like the do's and don'ts of playing in the space?
Yeah, I think just to note, you can't trade Sasol Kanyisa at the moment. You can trade Sasol Inzalo. Inzalo does look interesting with the discount to Sasol, but Sasol has its challenges at the moment. So maybe you want to see how Lake Charles plays out. We're still waiting for the details from Discovery in terms of their deal. And then MTN Zakele Futhi will come back to market, I think, around about November, when trade becomes possible between investors. I think the do's and don'ts is certainly try and understand the deal, and because yes, the underlying investment is one thing, but there's some sort of funding structure involved with these deals in terms of how much debt they've used, kind of the cost of that debt, the terms, the lock-in periods, all of that. So it's very important to understand that, because if you cannot commit to a lock-in period of 5 years, it doesn't matter how attractive Kula Sizwe is. If you're going to need that money in 5 years, then Kula Sizwe is not for you. Okay. So you need to understand those things as well. And I think the principle of diversification applies in this sense, where you diversify across all of them.
Right.
Don't try and guess which one's going to be the best performing one. I think many people wouldn't have seen Putumanati coming, and delivering the way it did, because it didn't quite have the excitement of Sasol and some of the other schemes that were around at the time.
Right. And for you, Riaz?
So I think you need to understand your circle of competence, and if you are able to assess the transactions, there's often various different drivers to each transaction. You need to unpack it and know what will determine the value creation. And if you can't do that, best you ask the financial planner or someone who can help you.
All right. And then, when these schemes do mature, what are some of the taxes associated with them, if any, that people should also be aware of?
Yeah, well, if the deal has been successful and there's been some capital growth, then certainly there'd be some sort of capital gains tax liability. So you would need to go and see your advisor and do those calculations. But that's only triggered when you sell out of the deal, when you exit and you get your cash. So there'd certainly be a tax liability, capital gains tax liability. On the dividends, those dividends are paid net of dividends withholdings taxes.
All right.
Okay, so that's taken care of by the company. So those are the main taxes.
Those are the main. And just to go back to a point that you raised before about when the right time is to get in these schemes. If you come in sort of in the middle, as in you missed the launch period, if you come in the middle, you can. And then how would that work?
So you can on the ones which are open for trade. So you then would go onto the platform where they trade, and you would need to assess what the price is related to the value and decide if you want to go in. But typically, while they are trading, there's quite significant discounts in terms of the underlying value. So you would only trade it if you can hold it to the end of the period. And that's the key of most of these transactions. You need to be a long-term investor, 5 years, 10 years, even in Kulasiwe 15 years. And if you're able to do that, it's geared up for you. If not, if you're looking for a 1-year return, it's probably not the best place.
All right. So, but ultimately, I think we're all in agreement here that, particularly as part of retirement planning, if you do qualify, then perhaps these shares should definitely be in your books.
Certainly. If you look at the yield on Putumanati, it's 18 to 20%. Mm-hmm. You're not going to get that from a guaranteed annuity. You're not going to get that from a fixed deposit. So it's certainly part of the solution, but you've got your liquidity issues and you only get paid once a year. So there's some planning that needs to take place to make sure that your cash flows that you get from the different parts of your portfolio work for you. But Putumanati, fantastic dividend payer. Question marks around the ability to sustain the dividend going forward. Mm-hmm. That business is certainly ex-growth, has its challenges. But if you look at Sasol Inzalo, because of the discount, that yield is over 5%.
Right. And
potentially that grows to 10, 15% in the next 5 to 10 years. So that becomes quite attractive. Vodacom Yeboyetu looks like on a 5 to 10 year view, it can also be a fairly attractive dividend payer. So certainly to incorporate these as part of your retirement planning makes a lot of sense. If you're in your mid-40s now, you'll be retiring when Kulasiwe matures. The dividend yield on what you're paying today is going to be significantly higher than what you would be able to get in the market. Mm-hmm. So definitely something to consider from a long-term planning perspective.
Fantastic, fantastic. Craig, thanks so much for those insights. Riaz, thank you to you too. So if you qualify, definitely look into it, particularly as we are planning for the long term and we are planning to ensure that we retire while, of course, that many South Africans actually can't afford to retire. So BEE share schemes are certainly something that could assist on that regard. But that brings us to the end of today's show. And if you have ongoing feedback, do keep in touch with us by tweeting us at CNBC Africa or emailing portfoliowatch@abn360.com. Don't forget to join us again next week, Tuesday, same time, same place. That is 7 o'clock Central African time. See you then.